Hi guys, this is day 13 of the A2 Economics Revision Challenge, and today we are doing monetary sector, and within the monetary sector we're doing money supply. When we look at money supply, we're looking at the amount or the quantity of money that is circulating in the economy, and the measurement of this money supply has two forms. One is what we call the narrow measure, and the other one is what we call the broad measure. The narrow definition of money includes all the items which can be spent directly for goods and services, such as cash and current accounts in the bank. So when we look at narrow definition, we mean to say very liquid assets that can be used in terms of buying goods and services. On the other hand, when we look at broad definition, we have a definition which includes even the deposits and saving accounts which are not that liquid and that cannot be spent directly on goods and services. But we can easily, if we need to, convert that into cash, and that's why it's still part of what we call the definition or the supply of money. So broad money is simply that money which is not that liquid, while narrow money is money which is very liquid. And for us, narrow money basically focuses on those items which are used primarily as a means of exchange, while broad money includes even those items which are not as means of exchange but as a store of value. When we say store of value, we mean to say basically if you look at your savings account and deposits, they give you interest as well. So that interest that is earned is a store of value. You are trying to save in terms of measures which are broad money. Now that we know the definition of money, money supply, let's talk about sources of money supply, or how can the government change money supply in an economy. Well, the first way the government or central bank can change money supply in an economy is through bank lending. An increase in commercial bank lending or credit creation can result in money supply to go up. So more bank lending can result in our money supply to go up. So let's talk about why does this happen. Well, the idea simply is that if the commercial bank is lending to customers, we say that will result in creating more money. So whenever a bank receives a deposit, basically what happens is that it keeps some part of it in terms of reserves, while other that it has, it lends it out. And by lending it out, what happens therefore is this, that the money supply in the economy goes up. And the reason is simply that when the banks are lending, they are creating more deposits as well. Why? Well, simply the idea that when the banks are lending, they are lending it to people who may then use the money for transactions, and that transaction can somehow become more deposits if those people who receive that money later put that money in the bank. So I'm going to show this through an example. Okay, let's do an example. Let's say we have bank number 1, and let's say bank number 1 receives a deposit of 100, and let's say right now our reserve ratio, which is a ratio which is set by the government or central bank, which tells us how much of the money central banks are requiring banks to retain. Let's say it's 10%. Now, why do we need to have this reserve? Well, simply because let's say if I put $100 in a bank, and let's say if I need some money, I go to the bank and I say I want my money back, or at least I want $10 or $20 of my money, and if the bank says I'm sorry, we have just given it to somebody else as a loan, then I will be very unhappy. So there is always some amount reserved in a bank for people to claim later on when they need money. So you keep some money in the banks as reserves, but the rest of the money, let's say 90, you give that as loans. So this is a bank account where the deposits become what we call the liabilities of the bank, and reserve and loans are the assets. Now this loan is given to, for example, an individual. Let's say it's given to individual A, and that individual A then spent goods which were bought from individual B, and let's say individual B decides to put it in his bank number 2. So when he puts it in the bank number 2, now the deposit will be 90, of which reserves will be 10% of 90 or 9, and the loans will now be 81, which means again I have a situation where I have new loans of 81. Now remember, this is the initial deposit. This initial deposit created another deposit of 90, which then went out to loan as loans of 81, which will then become another sort of deposit of 81, which will then become another deposit of 10% of 81, which is I think 72.9, and this goes on and on and on. So initial deposit 100 became another deposit of 90, which became another deposit of 81, and I'm reducing 10% every time till you will realize all these deposits will end up to 1000. Now, why did I come up with this number 1000? Well, the idea is simply because there is a formula which says that the money supply in an economy, in fact, the money multiplier in an economy, let me write this, there is something called a money multiplier in an economy, is equal to 1 over reserve ratio. Our reserve ratio is 1 over 10%, which turns out to be our money multiplier. Let me call it MM for short form. So my MM would be 1 over 10% or 1 over 0.1, which is equal to 10. So my money multiplier is 10. Now how do I use this money multiplier to know what will be my money supply? For that I use this equation. I say this, that the change in money supply that happens in an economy is equal to our initial deposit times money multiplier. So what's my initial deposit? 100. What's my money multiplier? 10. So what's my change in money supply? And the answer will be 1000. So my change in money supply from one single deposit of 100, this was the initial deposit, let me write this here, initial deposit of 100 led to increase in money supply of 1000. Now a lot of times the questions in exams come where they say, okay, if this is my reserve ratio, this is my initial deposits, what's the total change in money supply, and your answer will be 1000. But what they can also ask you, what is basically what is the change in deposits? The change in deposits will be basically 1000 minus 100, the initial deposit, which is going to be 900. So that could be two possible questions that can come. Also, this change in deposits is also the change in lending that can happen, because once an initial deposit of 100 was made, let's see this, once an initial deposit of 100 was made, if I add 90 plus 81 plus all this, these are the subsequent deposits or subsequent lending. So two kinds of questions that can come. One is basically what is change in money supply, that will be basically 1000. Then there can be what is the change in deposits or change in lending, that will be 1000 minus the initial deposit or 900. Okay, so that's one thing we need to remember. One more thing which we need to remember is that how can government use, or how can central bank use this tool to manage money supply? Well, simply if we increase the reserve ratio. So if the reserve ratio goes up, or higher the reserve ratio in an economy, we can say this: lower will be the money multiplier, and therefore lower will be the bank lending. And when the bank lending is lower, we will know money supply will fall because not enough loans will be generated. So by commercial bank lending, we could control money supply. So because each lending becomes a deposit and all deposits are counted as money. So that's an important thing to remember. Now we said this, that so by lending out, the bank creates more deposits and increases money supply in the economy, and therefore reserve ratio becomes a tool to lower that lending. When you increase reserve ratio, let's say if I make the reserve ratio to be 20%, then my money multiplier becomes 1 over 20%, which becomes, for example, 5. So therefore changes in money supply or changes in lending will be lower. The second method government used in order to control money supply is what we call open market operations. What are open market operations? Open market operations is simply buying and selling of government securities. Government security or bonds are a way the government can sometimes raise money from the market, but sometimes they are also sold or bought from the market to change money supply. So, for example, if the government is selling bonds or securities to general public like you and I, then basically we in return give the government money from our deposit accounts, but money supply will fall because the government then takes that money. And I'm assuming government is not going to spend this money. If the government doesn't spend this money, simply sell the bonds and take the money, money supply will fall. Similarly, if the government on the other hand is buying sort of bonds, so let's say buy bonds from the general public like you and I, then this results in money supply to go up. And the reason is simple. Well, the reason is simple because when the government is selling bonds, they take the money away. When the government is buying bonds, they get the bonds back, but the money goes back to the general public. So by buying and selling of government securities, the government can also control money supply, which is what we call open market operations. Within open up market operations is also another concept that we want to talk about, which is called deficit financing. So when we look at deficit financing, this basically government has a budget deficit and they need money to pay for those budget deficit or liability, which means that if the government is selling those securities, it's very likely to spend that money. So that's one important thing we need to consider, because in the first example here, the government was not meaning to spend money. When they sell bonds, they get the money, they don't spend it. But what if they sell bonds to people and then they have to sort of spend it because there is a deficit? So when the government uses government securities to borrow money to finance deficit, we need to look at who are they selling to. If the government is selling these bonds to the central bank or to commercial bank, we say that this will result in a multiplier increase in money stock. So look at this, guys. If this is the bank right now, right, and this is from our previous example. Let's say this bank has a deposit of, let's say, 100, and this 100 has, let's say, 10 as our reserve, so R for reserve, and let's say loans are 90. What if this 90 loan is not given to people, but let's say the banks are using this to buy what we call commercial banks. Commercial banks and central banks are using this to, let's say, buy bonds. So if this loan money is used to buy bonds, then this money will go to the government. So this loan will go to the government. Let me write this: government, which will then spend it in the economy, which will then become basically more deposits. And how many more? Well, the answer will be depends on the money multiplier. If the money multiplier in this case is if the reserve is 10, reserve ratio is 10%, money multiplier will be 10, and therefore you will see the money supply to increase by by 1000. So the idea goes is that if the government is selling these bonds to the central or the commercial bank, there will be multiplied increase in money stock, and this is because when the government undertakes this expenditure, the government spend this money, this will result in new money into the system, which acts as like an increase in the base on credit creation which takes place. So like the bank lending will not get affected. So when the government is selling to the central or commercial bank, the key thing to remember is this: money supply goes up. But what if the government is selling to the non-bank sector, to the private sector? Well, we say if the government is selling to the non-bank sector, then basically what the non-bank sector do is just that they take the money away from their deposit and they give it to government. So let's say if this is the government, this is basically non-bank general public, right? General public take out 100 from their, let's say, deposit, they give it to the government get 100 deposit, but that 100 goes back to the economy. The net effect of this would be the deposits will be unchanged. Some deposits go down because government securities are bought, the government then gets that money and then spend it into the economy, which means money supply go back again to the same level. So here when the government is selling to the non-bank sector, we say that selling to the non-bank sector does not have this effect because the public draws on their bank deposit in order to pay for the bonds, which would mean money supply remains unchanged. So things to remember for our discussion is that when the government is simply buying and selling bonds, money supply can change because when you sell bonds, money supply go down. When you buy bonds, money supply goes up. But what if it's a deficit financing? Well, if it's deficit financing, who are they borrowing from? Are they borrowing from the general public? Money supply will be unchanged. But if they're borrowing from the central commercial bank, then the money supply will go up. Last thing we want to talk about is particular total currency flow. The idea goes is that the total currency flow or the balance of payment refers to the money which is flowing into and out of the country. We say this if there is money coming in, let's say if x minus m is greater than 0, which means the current account is in a surplus, there will be money inflows, and all those money flow inflows, although they might be in dollar, but those dollars will be converted into rupees and money supply can go up. Vice versa, if the current account is in a deficit, there will be money outflows, and as a result of those money outflows, money supply will fall in the economy. So when the currency flows happen in terms of more money coming in, money supply will go up. Well, similarly, if there is more money going out, money supply will go down. So the third way the money supply can be changed is through basically inflows and outflows of the country's currency.